like a C minus area, high cap rate environment. It looks good on paper, but it's very, very intensive, management intensive to keep the property and, keep collecting rent. So as I'm getting older, I keep buying properties which are in better and better neighborhoods.
Are you looking to achieve massive success in your life without dealing with costly investment nightmares? If yes, then this is the podcast for you. Here, we provide engineers and busy professionals all the secrets and strategies to create multiple streams of income, build generational wealth, and live a meaningful life by design. Here's your host, Ted Patel.
Hey everyone, this is Ted Patel, and welcome to this week's edition of Decoding Cashflow Podcast. I'm here with Vince Rodriguez, who is a co-founder of Anvi Investments. He started buying real estate in 2018 and currently lead the team in acquisition of new assets. His company currently has 10 million plus worth of asset under management. Vince, welcome to Decoding Cashflow. Nice to have you on the show.
Hey, thanks for having me, Patel and Ted. Yeah.
So, Vince, before we dive deep into a specific niche of yours, right? Can you give our listeners a little bit background about yourself? How did you get started into real estate, and what's your main focus as of now?
Yeah, man. Yeah, thanks for having me on the show again. Yeah, I'm an engineer by trade, like all of us who come from India. We're either engineers or doctors. So I did that for a long time. I'm still an engineer for a medical device company. So that's my background. So I have an analytical background. So I read Rich Dad Poor Dad about 6 years ago and spent about 6 months reading all the books I could in real estate, and then bought my first triplex for about $250,000 in Bakersfield, California. So that's how I started my investing career. Basically, everything that could go wrong went wrong in that property, but I held on to it. I sold it, I think, 4 years later, a couple of years ago, for a six-figure profit. But I had to hold on to it. That's like the lesson I learned.
Yeah, that's true. It's not, so sometimes if in fix and flips you can make a little bit money, but as
Mm-hmm.
the more you hold, you the appreciation kicks in, and uh, you can make much more, profit on that. I used to do when I started fix and flip wins back in 2012, right? I started with fix and flip, as I mentioned earlier, so before this podcast, and now I regret selling those properties. If I would have hold on to the properties, all the ones that I had fix and flip, refinance, and kept it for myself, each and every one of them, I wouldn't be doing this podcast. I would be laying on the beach right now, doing nothing.
Yeah, I've never met anybody who sold real estate and said, that's the right thing to do, in a
Yeah,
long period of time.
yeah. Right. In the long term, right? It's always
Yeah.
uh, and it's about building wealth, right? Building cash flow. That's what
Yeah.
matters. Yeah.
Yeah. Just
So
like the name of your show.
decoding cash flow, exactly. That's what we help. We try to give our investors or listeners knowledge or information about what are the different avenues through which they can have a steady cash flow.
Yeah, that makes sense.
Yeah. So, Vince, you said you bought your first triplex in California, right? Can
Yeah.
you run us through that first deal of yours, a little bit more in detail, starting from acquisition to, dispositioning the asset?
Yeah, yeah, sure. So that was about 2018. People were telling me, the market's too high, you shouldn't buy, you should wait. I'm like, morons. So they always tell you. It's funny. It's always the guys who don't own anything always want to give you the lot of advice. I'm like,
That's right.
dude, you're like, you don't have anything. Why are you talking to me? But so I spent some time on MLS, and I had I didn't know much, so I got a realtor from Orange County who would drive with me, and we'll go look at properties in
Okay.
Bakersfield. It's a long way away. Then we made an offer and we got one. It is the worst neighborhood you could buy in. It is right next to a hospital. It's a D neighborhood for sure. And
Mm-hmm.
then, there was 3 units. Middle unit was empty. They were stealing power from one to the other. They were selling drugs, doing everything. It took me about 6 months to stabilize that property. But
Mhm.
before I get into that, a little bit of background, the way I got that was I saved about $20,000. By then I was like 30 years old or something. And my buddy, Andrew, had about $20,000. So we put in all of our money, and then, we had like 50 grand. So we put everything in it, and we bought the place, and, nobody was paying, rent. So we were like, what? This is, well, how is this happening? We were struggling really because we didn't know how to evict these guys and do all those stuff. So I eventually, what I did was we hired a property manager. Three property managers quit on us because that's how bad the property was. So eventually got a property manager, and we found a cop, and we put the cop in the middle unit, and everybody disappeared the next day, all the other druggies. So that was the that was the lesson I learned. So then we eventually were able to cash flow. We built like nice fences and made that property nicer, but it was still a challenging area. So it's just a
Mhm.
little struggle. So we bought it for 260, sold it for 460, 470 4 years later. So even if you assume we didn't make any cash flow for 4 years, and let's say we spend even 100 grand, we didn't spend 100 grand, but maybe in repairs, we still cleared like 100 grand profit, right? So if you put in
Mhm.
50 grand, we got 100 grand. That's 200% return. It's just not bad for 4 years.
Yeah, no, not bad at all, man.
Yeah.
And how you said you did 100 grand of rehab? That's what you're saying?
No, I'm saying like if you consider like the rents lost and repairs
Okay,
and capex and all that
everything.
stuff,
Hmm.
maybe it's 100 grand. I don't think so, but I'm just saying even if worst case scenario, I still made like over 100 grand on that property.
Hmm. No, that's good, and maybe because it's near to the hospital, that's one of the advantage, right?
Yeah,
Sometimes
I had
people
so many
like,
offers too.
yeah, because people like to live near the workplace. So whoever
Hmm.
is working at the hospital, nurses or uh, doctors, whoever wants to
Yeah.
rent for a temporary period of time, also, they will
Yeah, it
come in.
was a D neighborhood, but there wasn't real like crime. Nobody was like shooting people and doing like crazy stuff. You'll have like, somebody won't pay rent. That's the worst of it. So like if I go there, I'm not like worried somebody's gonna shoot me. So I like
Understood.
that one. So it's just like a little bit
Mhm.
more squatting.
All right. So now, as of what's your business model as of now? Like acquisition of the properties. What do you look into the properties before you buy them? And what's your hold period? Can you just give our listeners a little bit overview on that?
Yeah, it's one thing to, read books, Ted. So, like I thought I was so smart, so much ego, like engineers, like, yeah, I know all these. I have four GPA, some stupid stuff like patents and stuff. You find out you're an idiot, like you don't know anything, it's just like, what? There's so much to learn. So once you kind of tailor your ego and expectations and try to learn from other people going to meetups and stuff. I learned a lot of stuff like, you can change the property, you cannot change the neighborhood, like you cannot change the tenant that you put in the property. So it's like you got to do a lot of work before you buy the property, before you put the tenant in. If you want to attract a certain caliber of people, the property's got to be a certain way. If you just
Mhm.
have, you know stuff everywhere, then you're going to attract the wrong crowd, and then it's not right for the property. So all these things, it takes time, like months, years and years to learn. So, over time, I've honed my skills in terms of what I prefer, what I don't like. I don't like D neighborhoods. Obviously, it's too much management
Yeah.
intensive for me. So my investment strategies over the years have changed from um, like a C minus area, high cap rate environment. It looks good on paper, but it's very, very intensive, management intensive to keep the property and, keep collecting rent. So as I'm getting older, I keep buying properties which are in better and better neighborhoods and which on paper will have less and less cash flow, but is much better for me because the tenant base is different. I'm buying newer builds. The last two properties I bought was built like a couple of months ago. and I'm getting all these incentives. So my strategy is shifted towards builders, like kind of like what you're doing. You're doing ground up development.
Yeah.
You need a lot of guts to do that. I don't have that much, so I'd rather just buy from you and leave all the risk to you, and I'll pay you a premium to buy the property, because yeah, of course it's challenging environment to build when the interest rates are high and stuff. So that's what I've been doing. So I've been going to nicer areas, more landlord friendly areas like Tennessee. I prefer
Mhm.
that. And but I still hold most of my portfolio is in California.
Okay. So you started venturing out of state also. Like,
Yeah.
do you have anyone boots on ground in Tennessee, or it's just you put a property manager on the site?
Oh, hell no. So what I do is we are doing furnished midterm and short-term rentals now.
Okay.
Mostly we prefer midterm. Sometimes we even get like, 6 months plus. But what we have like a team north of Nashville. We have
Hmm.
a realtor, Vicky. She's really good. And she also does interior design and sets up the property. I just pay her a small fee. We have
Hmm.
my buddy Rob, who actually moved to Tennessee, and he has some properties in Chattanooga and north of Nashville, Hendersonville area. So we use those teams, and he manages. I just have 4 units, right? North of Nashville and Hendersonville. So he just manages them. I just pay him like, 400-500 bucks a month, and he kind of just
Hmm.
looks it over.
Okay.
And he takes over, and he has the Rolodex of cleaners and stuff. I'm also aware who they are. I've met them and I've talked to them, but
Hmm.
I'm only paying bills
Hmm.
for Tennessee and stuff. Yeah.
So he takes care of all the like management things. He keeps a
Yeah.
check on the property, making
Mm-hmm.
sure everything looks good. Any small fix that needs to be done on the property, he'll take care
Yeah.
of those. And then okay, so this you said it's a short-term rental, right? Short-term to mid-term rental, probably.
Yeah, so we do furnished rentals now because
Okay.
what I've figured out with the law with the lower cash flowing areas like A neighborhoods and stuff, it's harder to break even and not lose money if you just do regular long term.
Hmm.
I do the math, so at least it is breaking even. But I raise money too. So I raise
Hmm.
money from my family and very close friends. So
Hmm.
you have to give them some form of coupon rate, right? So
Yeah,
nobody wants to give you 100 grand and you don't give them anything. So
that's true.
even if I'm paying them like 5% a year or something, um, so I want to have some kind of buffer. So what I did was I started putting a little bit more money, furnishing them nicely. And then people who, there's always some tornado or floods or, properties under construction, or they're building a new house, or people who are traveling. That sector always needs servicing. So I prefer
Mhm.
to cater to those guys. So that's what I've been doing.
Yeah, that's a really good move actually, because sometimes
Yeah.
people don't want, because they are there for the short period of time, maybe for 3, 4, 5 months, and they don't want to buy all the furniture, TVs, bed, everything.
Hmm.
Just it's a lot of hassle, as well as it's an investment for them, and once they leave the place, they'll have to either move it back, which costs them, or they'll
Hmm.
have to throw it away. So that people would prefer those kind of short-term rentals, uh, where
Yeah,
they
you're right.
are, yeah. Okay, all right, great. So now you mentioned about, you take or the investment that you get from you get it from your friends and family, right? Of course, it's not 501c. It is, do you do 506b, or just general partnership
Yeah,
on your
yeah, good
projects?
question. So the way I do it is we call it TICs, right? So it's called tenants in common. So
Hmm.
I take ownership as tenants in common on the title, and everybody has ownership on the property itself. So let's say you and I do, it'll be like Ted Patel owns 60%, and my LLC will own 40%. Then everybody who puts in money gets 60% of the property and 60% of the profits. And I just operate it, do everything, find everything, run everything, pay the taxes and everything. And I believe I charge like a 5% fee to run everything, and then I keep 40% of the upside. So what ends up happening is you basically don't really make any money on my side for a long time, but I'm playing the long-term card. So even if there's no cash flow or like something happens to the roof, I usually just pay for it out of my pocket. and then I wait till I can refinance. Even when I refinance, I'll spread it 100-0 till you get paid back. It's very so since I've done syndication and I know how the model works, I kind of like copied that model,
Hmm.
except for the I don't charge a lot of fees, so no fees. So it's basically just I'm just trying to run the property as lean as I can, and then hold on to it, do a refinance, and then I win on the back end. So I'm playing the long game, and I've collected some equity along the way like that. But I've been working for free, I would say, for 6 years, but I collect a lot of equity.
Well, that's good, right? Sometimes you got to wait to win big.
Yeah.
uh, and it's so it once the ball starts rolling, right? Once you get more and more properties under the belt, you see cash flow, even if it is a little bit on one property, but when you
Mhm.
accumulate everything together, you see the numbers.
Yeah.
Okay. And what do you do about the financing of the properties? Like, how do you manage those?
Yeah, so all of my loans, so they're all Fannie Freddie backed government, loans. They're all agency debt. So
Hmm.
either I'm signing on the loan, my sister, my buddy, somebody is signing on the loan, and I just do the loan that way. So it's a little bit cheaper
Hmm.
than
And it's a
when it,
recourse loan, right?
yeah, yeah, they're all recourse because they're all
Yeah.
Fannie Freddie. Yeah, you
Because
would
it's
have to. What's that?
normally on like small properties, less than 10 units, normally it's, you have to sign up for that. You
Yeah,
have to
you have
back
to
the
sign
loan.
up for that. When I started, I didn't really care at all. Like I'm like, I was buying properties on credit cards, just doing crazy stuff because I'm like, oh, but if they sue you or if you lose the property, I'm like, okay, but I don't have anything anyway. It doesn't matter for me.
Yeah,
Take
when you're
everything.
starting up, you take the risk, right? Because
Yeah,
there's not much to lose at that point of time. But
yeah,
as you build along, then you got to get more sophisticated. Make sure
yeah.
you have an LLC, you have the
Mm-hmm.
proper insurance, everything in place.
Yeah, so I started off like that and then I started raising money, right? Soon as I was playing with like my sister's 401k and my friend's mom's retirement account, I became like more and more conservative. And I'm
Yeah.
like, I'm not playing these games. So I started off putting very less down. Now I don't do deals unless it's like 25% down at least. So I'm playing very more defensive now.
And you're getting it most from the MLS, or from your brokers, right?
Which one?
All these properties that you buy,
Oh yeah, I'm
it's
basically
mainly
just
from through the brokers.
yeah, just it's
No
just the MLS. Yeah.
MLS, no direct, direct
Off market
contact with
stuff.
the off-market stuff.
Actually, I did start in Bakersfield, California, because I started there and I was always there and doing deals. I go to their meet. I would drive to Bakersfield, which is like 3 hours, and go to a meetup there, like just crazy. So I met some local guys. So I did do a lot of off market, like really good deals.
Hmm.
And it just happens, it's a lot of time management, and doing stuff there. So I at one point had 30 to 40 doors in just Bakersfield, but I've sold most of them. I only have one property left there and
Hmm.
I started buying it elsewhere, right? So I haven't done too many off market, but what I do is I have a realtor, and I work closely with them. Different every market. Like my buddy Drew is a realtor,
Hmm.
and I don't even use him to buy the deals. So even though I have my buddy who's a licensed California realtor, I still don't use him to sell our own properties because that's not his highest and best skill. He's good, but
Hmm.
he's not. So like I'm selling a property in Orange County right now. It's $1 million listed for. If he sells it, we can keep, like 3% of that. That's $30,000, right? I'm still hiring my friend to sell that property, and he will only get 1%. So she gets 2% too, because she is way better than him in terms of
Hmm.
marketing and selling and showing the house and, talking to people. So you always want to use the best people. So that's always my trick is like, even though I can do it, I'll have somebody else who's better than me to do it.
Yeah. Similar for me, I also have a real estate license.
Oh, nice.
But I never indulge in using my license to buy and sell property.
Oh,
I
okay.
always use a broker or
Oh,
another
okay.
realtor. Yeah. Unless it's a very straightforward deal where I know I
Hmm.
got to buy this thing from him at this price, everything is all set, and we have agreed. I put my name. Otherwise, if I have to sell, I don't put my name. I let the realtor do the hard work because I,
Yeah.
I don't have time to just go and show the properties to the buyers.
Yeah, that makes
Yeah,
sense. Yeah, I think it's not the people like us, we're if we are more I like to do a little bit more like vision and planning and strategy for the company. I just do a lot more things because we're not very rich in terms of cash flow, right? So I have to do a lot of CPA stuff, doing
yeah,
some of the accounting stuff because I'm good at it. I don't like to do it, but I do it right now. But I'm trying to get out of most of those things.
that's great.
Yeah,
All right. So, Vince, uh, I'm really enjoying this conversation, but I want to be mindful of your time
sure.
also, and would like to transition to the last round of questions. Are you ready?
Yes, sir.
All right, sounds good. So, to start with, Vince, which is the one book that you'll recommend to our listeners, which had the most impact on your life or on your business?
Does everybody say Rich Dad Poor Dad?
Most of them. It's a purple
Yeah,
Bible, right? So
yeah.
it's a very common book. Most of the people who are indulging to real estate would know that
I,
book.
Yeah, I'll give you two follow-up books for that I
Okay.
highly recommend. So this the book that you want to definitely read after a step is Cash Flow Quadrant. There's
Hmm.
only two books you need to read by Robert Kiyosaki. He says the same thing again and again, right? So those are
Yeah.
the two best ones. And then the third book I would recommend is called Tax-Free Wealth by Tom Wheelwright. And that's also he's a rich dad advisor, and he's really good. And
Hmm.
any book by Ken McElroy is really good too.
Yeah, that's true. All right. So what are your main source of information to learn and grow? Where do you get all this information, analytic data or recent market situation? Where do you search those data?
I listen to a lot of podcasting, like like your show, Bigger Pockets and stuff. But since like we are every day in the field, like I can't wait for your book, to come out. By the time I read it, it's not as good of an information for me. So I'm like a druggie. Like I need the constant hit of like what's happening. So I'm listening to like House Wire Daily with Logan Motoshami. You know him, right?
Hmm.
Yeah, he's an analyst, and so
Yeah.
I'm listening every day, like just 20 minutes. What's going on in the market? I talk to my mortgage brokers. I follow like mortgage rates, what the Feds are doing, and
Hmm.
I make my own decisions because a lot of the things out there, they're just trying to get clickbaits and just trying to scare tactics just to get money. That's not
Yeah.
useful for most people. So I try to see where the market's going and make decisions on that because that's like what's very important. Like it's like saying like,
Absolutely.
oh, California is going to be a good investment. Yeah, like if you made it a long time ago. So it's like you want to find the next California, the next Nashville. So I'm always on the hunt for that.
And that's great, man. Uh, any business or investment advice you'd like to give to our listeners?
Yeah,
Especially,
sure.
yeah, before you get started, especially for the listeners who are already working 9 to 5 and want to get into real estate. Anything specific for them?
Yeah, what I would say, a lot of people, I might be a little contrarian on this. A lot of people are like, oh yeah, buy 5 properties and you can quit your 9 to 5. I say never quit your 9 to 5 if you don't have to, like my 9 to 5 is great, right? It's not too hard for me because once you're an engineer, doing like equations and solving problems, it's not like, oh, wow, how do I solve this? It's the same thing, right? Just a little
Yeah.
different. And I like a little creativity there. So that's good. So I would say don't buy two houses and quit your job. Keep your job and,
Yeah.
keep developing your side hustle. told you you're very comfortable, because I'm very risk averse. I don't like, especially, I don't have kids or wife at home to feed, and I'm still averse, right? Especially if you have kids and stuff, you shouldn't take that kind of risk and just go be like, oh, I'll figure it out. That's not a good
Yeah.
strategy. So I always tell people, keep your job and make sure you can substitute your regular income with real estate. Then you can quit if you want to.
Yeah. No, absolutely. You're rightly said, right? Make sure your passive income exceeds your active income before you take any decision to quit your job.
Yeah.
That's right.
Like if I quit my job and just said like, I control 10 million of real estate, I'll probably lose half of them in like 6 months, because I don't have the income to pay for a stupid roof repair or something. There's always something going on. So the way I sleep at night is my W-2 income.
Yeah, that's great. All right. Vince, last question. Where can Decoding Cashflow listeners get in touch with you?
Yeah, the best way to get in touch with me will be IG. So I have a couple. It's vince.capital. That's easy to find, or Anvi Invest on Instagram. You can also listen to my podcast, which you should be on shortly. It's called RE Social Podcast.
Okay. I'd love to be there, man. Just send me the link. We'll
we'll set
it
it
out.
up.
Yeah. All right. Vince, it was nice to have you on the show. Nice talking to you, and we will stay in touch.
Thanks, Ted.
Thanks for listening to Decoding Cashflow, brought to you by Aster Capital. If you found value in this episode, then please share it with someone who you think could benefit from it. And make sure to act on what you've learned. If you want Ted Patel to personally help you reach your goals, then feel free to set up a one-on-one call with him. Also, visit us at astercapital.com for more free resources. Content of this podcast is for informational purposes only. As always, please consult your own advisor before making any investment decisions or setting a course of action. Thanks again for joining us on this episode of Decoding Cashflow, and we'll catch you in the next episode.